In this session, let's look at the computations of the accumulated value, especially if the interest rates are changing. Interest rates are changing year over year, so they are not constant for over the time period. So probably in first year it may be I1, then I2 in the second year, I3 in the third year. So this kind of a models where we are trying to compute the accumulated value, probably the expected accumulated values, as well as the variation in the accumulated value, variance or standard deviation in the accumulated values, because the interest rates are not assumed to be constant for the entire period. They are assumed to be volatile during the period. So that is where we are calling them as stochastic varying interest rate model. So whenever we are talking about this varying interest rate, as I said, I am expecting that our interest rate is changing from year to year. But one more major assumption that is taken is, yes, they are changing, but they are changing independently. So probably the interest rate of year 2 is not dependent anyway on the interest rate of year 1. When we are talking about that kind of a mechanism, so based on these interest rates, I will compute the expected value of the interest rates. So which is the average or a weighted average. Expected value of the interest rates is taken. So which is generally called as some J, the expected value of interest rate. So this is the mean interest rate. Similarly, we are talking about the variation in the interest rates. We can find out the variance of the interest rates S squared. So based on these two numbers, once the individual interest rates for each of the periods are known, we can compute the expected value of the interest rates J, which is nothing but the expected value of the individual interest rates. Similarly, we can find out S squared, which is the variance of the interest rates, by going with directly computing variance as nothing but expected value of x squared minus expected value of x whole squared. Using this phenomenon, you find out the variance of the interest rate, and square root of that will give you the standard deviation of the interest rates. Now, based on these two, if I want my accumulated value after n periods, so a simple expected value of this accumulation is nothing but 1 plus j to the power n, which is the expected interest rate, to the power n will be the expected value of the accumulation. Whereas if I want to find out the variance of the accumulated amount, it's better that you go with 1 plus j squared plus s squared, take it to the power n, minus 1 plus j to the power 2n. This is especially a formula which you can use, especially if you want to find out the variance in the accumulated value after n years. So probably the expected value is this much. Variance is coming out as 1 plus j squared plus s squared to the power n minus 1 plus j to the power 2n. So simple logic, right? So if at all I want to know what is happening there, I could have taken expected value of so because the variance for me is nothing but, see, if I have to look at it, the variance, as I said, is expected value of x squared minus expected value of x whole squared. So expected value of x is something which we have already got, as 1 plus j to the power n is the expected value of. So probably here, to make it even more simple, variance of Sn is nothing but expected value of Sn squared minus expected value of Sn whole squared. So expected value of Sn, which we have already found out, 1 plus j to the power n. So that I am taking whole squared. So the second term is directly coming out as 1 plus j to the power 2n in our formula. Now expected value of Sn squared, if I want, it is nothing but expected value of 1 plus each I squared. 1 plus I1, I2, I3, 1 plus I1, 1 plus I1 squared, 1 plus I2 squared. So the summation of all of them. So basically I could have written it as expected value of 1 plus 2I plus I squared. So expected value of 1 is 1. Expected value of 2I, 2 into expected value of I, which is j. So expected value of I squared, right? Expected value of I squared, I could have written it as variance of I plus expected value of I whole squared, because variance of I is nothing but expected value of I squared minus expected value of I whole squared. So expected value of I squared, I could have written it as variance of I plus expected value of I whole squared. So this is becoming 1 plus 2j plus j squared plus variance of I. So which is nothing but 1 plus j squared plus variance of I, we have taken it as s squared. So obviously this is coming out as 1 plus j squared plus s squared to the power n minus 1 plus j to the power 2n. So this is what is coming out to be the variance of my accumulated value. So one kind of situation which we would see here is, given the interest rates are volatile, given the interest rates are variable year over year, I will end up finding out the expected value of the interest rates. I will end up finding out the variance of the interest rates, and based on the, once I have found out J, which is the expected value of the interest rates, S squared, which is the variance of the interest rates, I can use both of them to find out the volatility, the expected value of Sn as well as the variance of my Sn. So that is one set of mechanism which I can use to compute the accumulated values and their volatilities, especially if the interest rates are not constant across the period. The other set of mechanism that is being discussed is, what if the interest rates follow a distribution? Another set of questions which we generally observe is, okay, the interest rates are expected to follow a distribution. Instead of saying these are the interest rates for different periods, I am trying to see that the different interest rates are following a distribution. For example, 1 plus I is expected to follow a log normal distribution, right? So probably a log normal distribution will have mu and sigma squared as the parameters for it. Similar, if that is the case, 1 plus I to the power n, which is nothing but Sn. Sn then is again assumed that it will follow a log normal distribution itself with n mu and n sigma squared as the parameters. Right, so if Sn is following a log normal distribution, as per the property we can say logarithm of Sn will follow a normal distribution with again n mu and n sigma squared as the parameters. And so from here probably we can say that the z, right, when we are talking about the probability of some, see, probably log Sn is following a normal distribution with this, means x minus mu by sigma log Sn minus n mu by square root of n sigma squared. This is following a normal distribution with 0 and 1, means this is actually a kind of a z value that needs to be found out for typically finding out probability of Sn greater than or equal to some x, or probability of Sn less than or equal to some x. To find out some such kind of stuff, we can very well use, especially if someone is saying 1 plus I will follow a log normal distribution with some mu and some variance, we can very well say Sn is following 1 plus Sn is nothing but 1 plus I to the power n. This will follow a log normal distribution with parameters n mu and n sigma squared. So logarithm, so the definition of the log normal distribution is nothing but the logarithm of Sn will follow a normal distribution, but to make it standard normal distribution, I'll subtract x minus mean divided by the standard deviation. So that is giving me that x minus mu by sigma is following a normal distribution with the mean 0, variance 1. So from here I can very well find out the probability of Sn less than something or greater than something by finding out the z value and trying to map this z value against a z table, trying to find out the probability of the value lesser than that or greater than that kind of scenarios. But sometimes what could happen is, for the interest rates, see, we also know, if at all we don't have these values, we also know that if 1 plus I is following a log normal distribution, then the expected value of the 1 plus I can be obtained as e power mu plus half sigma squared, and similarly the variance of 1 plus I can be obtained as e power 2 mu plus sigma squared into e power sigma squared minus 1, or probably this is expected value of 1 plus I squared into e power sigma squared minus 1. So this is a kind of a relationship for variance of 1 plus I and expected value of 1 plus I, assuming that the 1 plus I is following a log normal. So from here also we can derive the parameters mu and sigma squared. If I don't know the parameters directly, I can derive the parameters from mu and sigma squared. Then I can talk about n mu and n sigma squared for n period investment, and from there I can take log Sn minus n mu by square root of n sigma squared following a standard normal distribution, which can actually help me in trying to find out the probability of a value lesser than something or greater than something, such kind of numericals. So anyhow, we will be taking a few numericals to understand this concept even more in depth, different variants of the numericals, where we see the examples of 1 plus I following some kind of a distribution, or even otherwise when I have the expected values of i's and the variance of i's for each of the periods, how am I taking them together to compute the overall accumulated value and the variance in terms of the accumulated value for a n period investment, right? We'll take different kinds of numericals to understand that concept in much more detail. All right. Yeah. Now we will try to understand what could be the important reasons that can result in a change to the interest rates. The first primary thing I look out for is a change in demand and supply. Probably if I am looking at a 10-year investment, I cannot have a constant interest rate for the entire 10-year period because there is a constant change in demand and supply, one for bonds which are based on the interest rates and for that holding of money itself. So various things associated with the demand and supply cause a difference to the interest rate changes in over a time period. For example, if we see, if the corporate, the government, everyone is coming forward to raise capital, right? At some point, let's say the government or the private entities, the corporate, they all want to expand their business, so they choose raising capital through bonds issue as one of the major mechanisms to raise capital. So when more and more of those kinds of issues are coming up, more bond issues are coming up, you see that the supply is increasing very heavily in the market. So more of a supply means the price of those bonds should come down. So someone who has purchased the bond at such a lesser interest rate, we are seeing that the yield or the interest rate corresponding to that would be much higher, and vice versa. The more and more people, investors come forward to invest in fixed interest bonds, more demand is going up. The higher is the demand, people don't even mind paying a higher price for purchasing those bonds. So when they have purchased a bond at a higher price, the cash flows not changing, the coupons not changing, overall IRR or overall yield to maturity for that bond will typically fall. So what we are observing is that interest rates over a period cannot be constant, they are always variable. One prime reason contributing to that being the supply and demand for the various financial instruments changing over a period. Apart from that, the RBI's interventions, the central bank's intervention in terms of changing the base rates itself, right, as a part of the monetary policy of the central bank, it will get into either increasing the money supply, which is called as expansionary monetary policy, or controlling the money supply, which is called as a contractionary monetary policy. So because of the policy that is being adopted by the central bank at different points in time, with a view to control inflation, with a view to improve the economic activity in the country, so with a view to reduce unemployment. So with so many objectives in front of them, the central bank can actually use the monetary policy, and because of that, what you see is the base rates keep changing. So the base interest rates changing means all the other interest rates in the country which try to price themselves on the basis of that base rates will also undergo a change. So the interest rates could change even because of this, and because of the various bilateral trades that exist across various countries, and based on the exchange rate differentials across the various countries, across the various currencies, we see that the interest rates also change. There is interest rate parity theorem which suggests that the exchange rate differentials, right, the exchange rate difference between the two countries is a reflection of the interest rate differentials between the two countries. So when the exchange rate has changed by a certain extent, we obviously see that the difference between the interest rates also do come up, and that is one more reason the interest rates are bound to change. even the future inflation, the expectations about the future inflation also could change the interest rate, because we have seen 1 plus the money rate or nominal rate is same as 1 plus real rate multiplied by 1 plus inflation. So if the inflation in the future is going to change, I see that the nominal rates or money rate of return is also going to change. So that is one more factor that could contribute to the interest rates. And finally the taxes. All these are playing a very heavy role in controlling or increasing of the interest rates. So when we try to understand the accumulation values of investments, it's very much important for us to understand the role that is played by these interest rates, how the interest rates change over the future. Based on this, what is the expected value of the accumulation, as well as the variance or standard deviation that is present as a part of the accumulated value, so that we can take decisions much better, right? So with all these in place, it is very comfortable to assume that the interest rates cannot be constant for the entire period of investment. They do keep changing. So the way we are able to forecast them and the way we are able to compute the expected as well as the variance associated with them will decide what could be the typical returns we can get out of our investments, right? Now let's look at the scenario of the accumulated value when we are talking about stochastic interest rates, which means for each of the periods the interest rates are volatile. When we talk about deterministic interest rates, the interest rate is fixed for a period. Deterministic, the interest rate is fixed for a period. But when we are talking about stochastic, the interest rate is not fixed for a period. It follows some kind of a distribution. The interest rate follows some kind of a distribution. So there is some kind of expected value for the interest rate as well as the standard deviation associated with the interest rate for each of the periods. When I have such kind of a scenario, how do I find out the accumulated value of my investment? For example, here I am expecting that in the next year the interest rate is going to be 7.2%, but at the same time assuming that there is a standard deviation of around 1.5%. So it's not fixed. The mean rate is going to be 7.2%, but the standard deviation in the interest rates is looked out at 1.5%. The same case goes with the year 2, where the interest rate is assumed to be 9.7% on an average, with a standard deviation of around 1.8%, and the same scenario with I3, 11.4% being the expected rate and a standard deviation of 2%. And for that we are talking about what would be the value of the investment. So to address these kind of various interest rates during various periods, 2.7 at time 1, then 3.7 at time 2 and 7.3 at time 3. So probably the way we are getting our accumulated value at the end of 3 years, the accumulated value at the end of 3 is nothing but the 3 is in 2.7 at time 1. So this 2.7 will be invested at I2 for one period, and it would be invested at I3 for one more period, and at the same time you will have 3.7 invested at I3 for one period, and of course the last one 7.3 will be invested, it's invested at the end of the third period itself, so there is nothing. So the typical accumulated value is coming to be something like this for the investments. But of course, I2, I3, they are all variables. They are following some kind of a distribution which have an associated expected value as well as the standard deviations. So based on that, now for this, if I want to find out the expected value of S3, I can take the expected value of all this. And the good thing is, because all I1, I2, I3 all are independent, I can very well consider all of them inside. So it could have come 2.7 into 1 plus expected value of I2 into 1 plus expected value of I3 plus 3.7 into 1 plus expected value of I3 plus 7.3. That would be the expected value of your accumulated value. Okay, so I1, let me take it as 7.2%. SD1, I'll take it as 1.5%. I2, I'll take it as 9.7%, and SD2, I'll take it as 1.8%. Then I3 comes as 11.4% with SD3 around 2%. Then cash flows wise, okay, if I want S3 in this case, it is nothing but 2.7. So cash flows also, let me write down. First year it is 2.7, then it is 3.7, then it is 7.3. So S3 is coming out to me as 2.7 times 1 plus expected value of I1 multiplied by 1 plus expected value of I2 plus 3 point, sorry, here I2 and I3. So expect, because I am investing 2.7 at the end of 1 year. So it will pick up the interest rate of the second year as well as the interest rate of the third year to give the accumulated value at the end of 3 years. Similarly, this 3.7 will accumulate, will have an interest rate associated with 7.4, 11.4, whereas the third year, something that is invested at the end of the third year, is carrying no additional interest because this is invested at the end of 3 years itself. So the expected value of S3 is straightforward. The expected value of S3, the accumulated value at the end of 3 years, is straightforward. But the trouble comes with respect to the variance computation, because this is nothing but the variance of, okay, 2.7 times 1 plus I2 times 1 plus I3 plus 3.7 times 1 plus I3 plus 7.3. Now we know that the variance does not exist for a constant, so this I don't need to consider as a part of the variance computation. So obviously this becomes variance of 2.7 times 1 plus I2 into 1 plus I3 plus 3.7 times 1 plus I3. So overall I could compute this as a taking 1 plus I3 common. I would take out 1 plus I3 common, then I would say 2.7 plus 2.7 I2 plus 3.7. So this is becoming variance of 1 plus I3 multiplied by 6.4 plus 2.7 I2. So the variance of these two things, 1 plus I3 into 6.4 plus 2.7 I2. Now, the variance of the multiplication like this, the way I could have written is variance is nothing but expectation of x squared minus expectation of x whole squared. Right? The same logic I'll express here. Expectation of x squared. So 1 plus I3 squared into 6.4 plus 2.7 I2 squared. This is expectation of x squared minus expectation of x. Expectation of these two things. Expectation of 1 plus I3 into 6.4 plus 2.7 I2. So this value squared. This value squared is easy to determine. 1 plus I3 times 6.4 plus 2.7 I2. Okay, I will find out the second term of this expression, which comes out as 1 plus I3 times 6.4 plus 2.7 times I2. This is the squaring which I have to do on the top of this. So let me do a squaring on the top of this to get my second term, which is 55.07. So now I am left only with expectation of x squared. 1 plus I3 into 6.4 plus 2.7 I2 square. The square of this. Now we know, so probably let me write it out. 1 plus I3 into 6.4 plus 2.7 I2. So I'll write it as expectation of 1 plus I3 into 6.4 plus 2.7 I2 squared. So here I can again use expectation of x squared is nothing but variance of x plus expectation of x whole squared. That is, so this will come out as the variance of, so each one, this comes out as variance of 1 plus I3 in plus expectation of 1 plus I3 whole squared. This is the first part. This I will multiply with variance of 6.4 plus 2.7 I2 plus expectation of 6.4 plus 2.7 I2 squared. These are the numbers. So now I know, well, once I know the variance of I3, I don't need to, the 1 plus I3 also will have the same variance because variance is not applicable for a constant. So variance of 1 plus I3 is nothing but variance of I3. So standard deviation squared comes out as the variance plus expectation of 1 plus I3. So 1 plus 11.4% squared. This is the first term. So that's the way I can go with. Okay, variance of, so if I want my first term, I'm taking it as variance of 1 plus I3, which is 2% squared, plus expectation of 1 plus I3 squared. So 1 plus I3 squared. So this is the first part, right? Okay, I can probably take the number of it if possible with just 2 digits of decimals, right? Then the second part in this, variance of 6.4 plus 2.7 I2. For 2.7 I2, you will get 2.7 squared times variance of I2 1.8% squared. So this is the variance of 6.4 plus 2.7 I2, because for 6.4 the variance is not applicable, and expected value of 6.4 plus 2.7 I2 squared, 6.4 plus 2.7 times I2, right? 6.4 plus 2.7 I2 squared. So that is the second term, and I multiply these two numbers. This is the value, right? 55.09. This happens to be the value, and from here I can find out the difference, which is nothing but the variance. So the variance of the difference, variance of the accumulated value, right? The first part is telling me the first part is this, the second part is this. So the variance is nothing but this minus this. The variance of the accumulated value is going to be this much, and from here I can get my standard deviation as the square root of this, which will give me 0.14 or 14.38% happens to be the standard deviation. So the expected value is around this much, whereas the standard deviation is somewhere around this much for your accumulated value. So this is how we get into the computations of the accumulated values at each of these periods, right? Probably if there is so let me just check out 2% squared plus 1 plus 11.4% squared, and here also variance of 6.4 plus 2.7 I2, which is 2.7 squared I2 squared, 2.7 squared I2 squared plus 6.4 plus 2.7 times I2, this entire thing squared. So this is what is the standard deviation overall, and this is what is the average or mean of the accumulated value. So that's how we keep computing the mean and the standard deviations of the accumulated values in case the interest rates are stochastic in nature. Alright. How do we find the accumulation amount in case the interest rates are stochastic? When we say the interest rates are stochastic, they are not fixed for a period. They follow a distribution, right? That is what we mean by the interest rates are stochastic. They follow a distribution. They are not fixed for a particular period. So there is a variation in the interest rates that need to be considered, and based on that our appropriate calculations need to be looked at. But of course, if at all I want to find out the expected accumulation, probably the variation may not play any role. But if I want to find out the variance in the accumulated value, or probably the range of the accumulated value, in all these cases there is a dependence on the variance of the fund also, the variance of the returns also. So wherever the interest rates are stochastic and are not deterministic, when I say deterministic, there is one single value for each of the period, for probably for a different period, but whatever the period I am considering, during that period the interest rates are fixed. Whereas when we are talking about stochastic, they are not fixed, but they are taken on the basis of some distribution. So if you look at here, the annual returns of the fund are independent and identically distributed. For each year, the distribution of 1 plus I is log normal. It's not I that is log normal. 1 plus I is log normal. And the parameters, the mu is 0.0525 and the variation sigma squared is 0.00425. Then how do I find out using the parameters mu and sigma squared for a log normal distribution? How do I find out the expected value of 1 plus I? The expected value formula is e to the power of mu plus half sigma squared. I hope you remember this formula, especially if I want to find out the mean of a log normal distribution, the expected value of a log normal distribution, we will take it as e to the power of mu plus half sigma squared. So it becomes e to the power of 0.00525 plus half 0.00425. So let me find out what is the expected value of 1 plus I here. So e to the power of, so we can say expected value of 1 plus I is e to the power of 0.00525 plus half, which is 0.5 times 0.00425. This is what is expected value of 1 plus I. So expected value of 1 plus I is 1.007, right? Oh, sorry, the mean is 0.0525, not 0.005. So mu is 0.0525. So let me make the correction here. So the expected value of 1 plus I, using that, assuming that 1 plus I is following a normal distribution, expected value of 1 plus I is 1.056. So probably you can find out the expected value of I is nothing but you subtract 1 from it, making it 0.056 or around 5.6%. The expected value of, for this kind of a stochastic distribution, the expected value of I is around 5.61%. Okay, around 5.61% is the expected value of I. Now I need to find out the expected value of the accumulation amount only also. Means on an average every year the growth is around 5.61% and I am depositing 3,500 bucks every year at the beginning. So 3,500 bucks at the beginning of the period for 5.61% interest for a period of 28 years. I can very well find out what is the accumulated value, right? Either I can go with the formula based kind of stuff, because this notation wise, the accumulated expected value of the accumulation, I can always write it as 3,500 into S, which is the future value. Because the payments are made in advance, I will denote it with 2 dots, which is like payments in advance for a period of 28 years. Either this entire thing I can look at it with respect to 4.61, 5.61%, or probably I can directly use the formula itself. 3,500 into the value. For this, what is the value we talk about? 1 plus I to the power 28 minus 1 by I into 1 plus I. This is what is the formula we have for the future value of an annuity. The future value of an annuity payment comes out by this kind of a formula. So probably taking the I as 5.61%, I can find out the expected value of A, which is nothing but 3,500 multiplied by 1 plus I to the power 28 minus 1 divided by I, and that is multiplied by 1 plus I. This is multiplied by 1 plus I to give 238,065. For 28 years, at the end of 28 years, the expected value of the accumulation for this, going with 5.61% every year, it can work out to 238,065 rupees. The same logic, probably using another formula, especially if you are using a financial calculator, you can very well arrive at this as computation of FV based on an interest rate of 5.61%, number of periods being 28, and the PMT, which is a continuous recurring payment, a recurring payment every year being 3,500, and no present value in this case, but the payments being made at the beginning of the period. So using this also we would be able to generate the similar kind of a number. So that is what either I use this formula if I remember it, if at all the payments are made in advance. So if the payments are made in advance, the future value of the annuity will contain 1 plus I to the power n minus 1 by I into 1 plus I. But if they are paid in arrears at the end of the period, this multiplication factor will not be there. It will be only 1 plus I to the power n minus 1 by I. So for finding out the accumulated value, the expected value of the accumulation, there is not much of a big difficulty. But if wherever I have to take into consideration the variance, or probably finding out the probability that my returns will exceed some particular value, in those cases there is a lot of dependence on the variance and probably the distribution and all. But for expected value, even if it is a stochastic interest rate, try finding out the expected interest rate and use that interest rate directly for any future value or present value computations. As long as I am supposed to find out the expected value of the accumulation, I have no issues in terms of I have no issues in terms of using the plain deterministic interest rates model itself. But with this stochastic interest rates, we can even derive some kind of ranges or some kind of probabilities of exceeding a range or falling below a range. So those kind of simplifications become more easier when we are considering the stochastic interest rate situation. All right. Yeah, just continuing with this example, I would also look out for finding out the variance of the accumulated value. See, we generally, if my interest rates are following a stochastic process, here it's not a fixed interest rate, so this 1 plus I, we are saying that it follows a log normal distribution with this kind of parameters. So based on this, I should try to find out what is the mean, what is the mean of I, so which means what is the mean return and what is the standard deviation of the return. Once I know the mean and the standard deviation, I can find out for my accumulated values also what is the mean accumulated value and what is the standard deviation of the accumulated values. Now for the mean, we have seen earlier also that once, see, if I typically have to find out the mean, what did we say, what is the accumulation? Let's say if I am talking about S28 is my accumulation value of 3500, 3500 after 28 years, let's assume that it is becoming S28, right? Or for simplicity reasons, I'll take 1 is becoming S28 after 28 years. Now logically speaking, the expected value of S28, the way the S28 is coming up is the expected value of 1 plus I for the first year, 1 plus I for the second year, and so on, 1 plus I for the 28th year. So because we are saying that these are all independent and identically distributed, I can very well take it as the expected value of each one of them separately. And so from that standpoint, I could very well take 1 plus I to the power 28, right? So based on that, when I take expected value of 1 plus I to the power 28, that is what will give me the accumulated expected value of the accumulated. I'll get it as 1 plus I to the power 28, but for I need to know what is the expected I. So that is where we have used earlier, as I cannot directly find out expected I, we were finding out expected value of 1 plus I, because 1 plus I is following a log normal distribution. So we knew that the expected values of a log normal distribution is nothing but e power mu plus half sigma squared. So we have used that mechanism, e power 0.0525 plus half 0.00425, and whatever we have got, that was the expected value. So if I had to look out for this expected value of I using this mechanism, expected value of 1 plus I had come out to e to the power of 0.0525 plus half 0.00425. So the expected value of 1 plus I has come out to be this much, from where I have got the expected value of I to be this much. The same logic now I can use for finding out the variance of 1 plus I also, because again 1 plus I is following a log normal kind of a distribution. So the variance of 1 plus I, going with that formula for log normal distribution, e power 2 mu plus sigma squared multiplied by e power sigma squared minus 1. Right, that was what was our formula for 2 mu plus sigma squared multiplied by e power sigma squared minus 1. This was the formula for the variance of 1 plus I. So this is nothing but, by substituting the mu and the sigma squared parameters, I should be able to get the variance of 1 plus I. So e to the power of 2 mu. Mu in our case is 0.0525. Okay, 2 mu plus sigma squared 0.00425 e power 2 mu plus sigma squared into e power sigma squared 0.00425 sigma squared e power sigma squared minus 1. So this is what will try to give me the variance of 1 plus I. So we know that from the properties of variance, the variance of ax plus b is equal to a squared into variance of x, because the constant addition does not have any kind of an impact to the variance. Similarly, the variance of 1 plus I will be the same as the variance of I itself. Variance of 1 plus I will be the same of variance of I. So from here I can get the variance of I as the same number. So from here I can get the standard deviation of I, which is nothing but the square root of the variance, which works out to some 6.89%. That is what will be the standard deviation of the interest rate. So now that I know the mean of the interest rate as well as the standard deviation of the interest rate, if at all the question is not on the calculate the standard deviation of the expected accumulation, right? Forget about the 3,500 being invested, because if I know for 1 rupee, then it can be extended for 3,000 rupees or 3,500 also in the same way. Now if I have to calculate the variance of the variance of the accumulation, the standard deviation of the accumulation in 28 years of time. So which means I need to find out what is the variance of S28. For that we know the variance of S28 is nothing but 1 plus I to the power 28 plus, this is the mean, expected mean, plus we are talking about S squared, which is the standard deviation which we have got for the interest rate, the standard deviation or the variance of the interest rate to the power the time period of investment, minus again 1 plus I to the power 2 into 28. This is a direct formula. We had it as 1 plus I, variance of the accumulated value in case of stochastic interest rates. We said that it is 1 plus I squared. So it is 1 plus I squared plus S squared to the power n minus 1 plus I to the power 2n. This was what was the formula for the variance of the accumulated value at the end of n period. So I am trying to apply the same. So if I am trying to look at the variance in this case 1 plus I squared, so I will say variance of S28, which is nothing but 1 plus I squared 1 plus I squared plus S squared, which is nothing but my variance, S squared, this entire thing raised to the power of 28 minus of 1 plus I to the power 56, 1 plus I to the power 56. So this is what is the variance of S28, which I can take it in terms of dollars or rupees. So around 2.69 is the volatility, is the variance part. And obviously when I am looking at the standard deviation for the same, which is nothing but the square root of the variance, the volatility in this case is 1.64 rupees. So for every 1 rupee, the expected value at the end of 28 years. What is the expected? This is the expected value for 1 year. I need the expected value at the end of 28 years also. This is what it is. Oh, sorry, this is for 24. The expected value at the end of 28 years is nothing but 1 plus this to the power 28. So the expected value of the accumulation, the better way to talk about is the expected value of the accumulation amount is around 4.62 for every 1 rupee that is invested. The expected value of the accumulation at the end of 28 years is around 4.62 rupees, whereas the variance or the standard deviation of the accumulated amount at the end of 28 years is somewhere around 1.64 rupees. That is the standard deviation of the accumulated. Now, of course, if I want to find out for the 3,500 that is invested, I can very well find out whatever is the expected amount at that point, and on that expected amount I'll take a standard deviation of 1.64 for every rupee. So the variance wise I'll take 3,500 squared and the expected value at that point and multiply it with this particular value, and I can take the standard deviation as the square root of that particular variance. So if we are comfortable with 1 rupee, we can very well try understanding it for any amount, because variance is nothing but that particular amount square is what is getting into the calculation of the variance. So there should be a comfort in terms of understanding the stochastic interest rate, how the expected value of the same can be determined and how the variance of the same can be determined, and that too if instead of I something else is following some kind of a distribution, how do I find out the mean and the variance of my interest rate, and then how do I pitch it as a part of my computation of the expected value and the variance of the accumulated amount. All right. Now let's look at computation of the accumulated value. Computation of an accumulated value when the interest rates are stochastic. So the interest rates follow some kind of a distribution with some mean and some standard deviation. So if some amount X is invested today, what would be the expected value of this accumulated amount after some T years, and what would be the standard deviation in the accumulated value after T years. So those are some of the things, and apart from that also, what is the probability that on this day the amount will be lesser than some specified amount or greater than some specified amount, because the interest rates keep fluctuating during the period. All these kind of scenarios do come up, and even when this is the case, what is the amount that needs to be invested every year so that there is no problem with the accumulated value, at least 95% of the confidence. So all these kinds of scenarios can come up because we are not dealing with the deterministic interest rate. We are dealing with more of stochastic, which can change over a period. Let's try to understand this numerical and then try solving it. A life insurance company sold a single premium bond, okay, with a term of 10 years to maturity. Okay, so the period for this is 10 years. The bond gives a maturity payment of 150% of the single premium at the end of 10 years. It's a single premium bond. So let's say if 100 is invested as a premium, you are going to get 150 out of it at the end of 10 years. The company's investment strategy for this bond is such that the expected expected effective rate of interest from the investment So expected effective rate of interest from the investment is 8%, and the standard deviation of the annual returns is somewhere around 11%. And annual returns are independent, right? Year to year there is no dependency on the annual returns, and 1 plus IT follows a log normal distribution. Okay, 1 plus IT we are 1 plus I, it follows a log normal distribution where IT is the return in the teeth year. Okay, the company has received a premium of 20,000. So obviously 20,000 is the premium, and calculate. So it has to give 150% of that. So probably 30,000 is the maturity amount that it has to pay. Calculate the expected value and the standard deviation of the investment of 20 at the end of 10th year. So the expected value for me is the expected value of the investment, right, each year. So 1 plus I. So the I is following, I is having a mean of 8% and the standard deviation of 11%. So probably S10, whatever I am thinking of as the accumulated value at the end of 10th year, right? So accumulated value at the end of 10th year, it's nothing but 20,000 multiplied by the expected value of 1 plus I1, expected value of 1 plus I2, and so on up to expected value of 1 plus I10. And now that all of them are independent and identically distributed, it can come out as expected value of 1 plus I to the power 10. And now that I know that I is 8%, so this is as simple as 20,000 into 1.08 to the power 10. So the expected value, so here let me take at the end of 10 years, okay, time to maturity is 10 years, the expected value of the returns is 8%, right? The returns and standard deviation of I is following 11%. Okay, the standard deviation of I is 11%. 1 plus I is following a log normal distribution. Maturity is 150%, and probably premium is 20,000. Right, it's not percentage, premium is 20,000 in terms of amount. Premium is 20,000, fine. So S10, which is the accumulated value at the end of 10 years, the expected value of S10 for me is nothing but 20,000 multiplied by 1 plus the expected value to the power 10. So obviously the expected value is coming out to 43,178 rupees. Any 20,000 that is invested, the expected value at the time of end of 10 years is going to be 43,178 rupees. Now looking at the standard deviation for the same. Okay, the meaning of standard deviation, first I can try out for the variance. So all I require is variance of 1 plus I1 into 1 plus I2 into so on up to 1 plus I power 10 or I10. So it's as good as talking about right? Each of them, when I'm looking at their variances, it is because all of them are independent, it's as good as talking about variance of 1 plus I squared. So it's as good as saying variance of 1 plus 2I plus I squared, right? Variance of 1 does not exist. So it's as good as saying variance of 2I plus I squared. Or it's also better to write it as variance of I into I plus 2. We know from the formula variance of x is equal to expectation of x squared minus expectation of x whole squared. The same logic, if I write this is expectation of I squared into I plus 2 squared, right, minus expectation of I into I plus 2 squared. So this is the scope for the variance. I squared, expectation of I squared into I plus 2 squared. So whenever, okay, this expectation of I into I plus 2, I we have, I plus 2 we have, right? So expected value of I into I plus 2, expected value of I into I plus 2, if I want, it is I, expected value of I into I plus 2. So this is giving me, this is the expected value of I into I plus 2, and that squared. So this number squared is the expected value of I into I plus 2 squared. So this expectation of x squared. So expectation of x squared, is variance of I into I plus 2 . Let me redo it. Let's again redo it. Variance of x is equal to expectation of x squared minus expectation of x whole squared. Expectation of x we already know. We have computed the expectation of x. I don't require this. So expectation of S10 we already know, right? Expectation of X10, if I am looking at only the number part of it, only the value part of it, expectation of X10 is nothing but 1.08 to the power 10. So 2.15 is the expectation of S10. So expectation of X squared is something which we already know, right? Because I'm trying to find out variance of S10, which is nothing but expectation of S10 squared minus expectation of S10 whole squared. Expectation of S10 is already known. So here S10 will become expectation of 1 plus I squared to the power 10. Right, this is what will become, which means expectation of 1 plus 2I plus I squared to the power 10. So to the power 10 we'll try out. So which is expectation of 1, which is 1. Expectation of 2i will become 2 into 0.08, and expectation of I squared will come out as variance of I plus expectation of I whole squared. So variance of I is given as 11% and expectation of I is given as 8% squared. So expectation of S10 squared will come out as 1 1 plus 2 into 8% plus 11% plus 8% squared. So this will work out. So this is going to be expectation of I squared, and this I will raise it to the power 10. This I will raise it to the power 10 to obtain my expectation of S10 squared. Expectation of S10 squared is expectations of these things. Expectation of 1 plus 2 into expectation of I plus variance of I. The standard deviation is 11%. So probably variance means I'll take the square of this. So overall coming out to 5.16. Probably if I convert this into a number, I get the expectation of x squared as something like this. So from here I can find out the variance of S10. The variance of S10 is expectation of S10 squared minus expectation of S10 whole squared. So this is what is working out as the variance. So from here I can find out the standard deviation of S10, which is obtained through the square root of this. So the standard deviation is that much. So standard deviation of accumulated value will come out to be the amount 20,000 multiplied by the standard deviation. So overall 14,000 happens to be the standard deviation of the accumulated value. So the expected value is around 43,000 and the standard deviation is around 14,000. So these are the numbers at the end of the 10th year, right? Now the next part that is needed for me is calculate the probability that the accumulated value of the investment will be less than 60% of its expected value in 10 years time. So all I require is probability of S10 less than 0.6 into expected value of S10. We already know the expected value of S10. This is the expected value of S10. So the probability, or probably the RHS side, is 0.6 times the expected value. So 0.6 times the expected value. So all I want to know is what is the probability that S10, the factor, probability that S10 is less than 1.295, right? Now we know that if I want to know the probability of S10 is less than, so here we know that 1 plus I follows log normal, means log 1 plus I follows a normal, and the expected values are these ones. So the expected value of a log normal distribution e power mu plus half sigma square, that is equal to 8%, the mean right here. Okay, log 1 plus I follows I mean 1 plus I follows a log normal distribution of mu and sigma squared, right? So you can very well take that 1 plus I to the power 10 follows a log normal with 10 mu and 10 sigma squared. Whatever are the mu and sigma squared, we'll take them up. So it follows a log normal with 10 mu and 10 sigma squared. But the expected value of 1 plus I, right, because 1 plus I follows a log normal, expected value of 1 plus I is e power mu plus half sigma squared. But we know expected value of I is 8%. So expected value of 1 plus I is 1.08. So expected value of 1 plus I is 1.08. So e power mu plus half sigma squared, e power mu plus half sigma squared equal to 1.08. And similarly the variance of 1 plus I should be equal to variance of I, which is equal to e power 2 mu plus sigma squared into e power sigma squared minus 1, right? E power 2 mu plus sigma squared into e power sigma squared minus 1, that is equal to variance, and we know that the variance is nothing but 11% squared. So this is mean squared. If you look at this is nothing but a mean squared. So 1.08 squared into e power sigma squared minus 1 equal to 11% squared. So e power sigma squared minus 1 will come out as 11% squared divided by 1.08 squared. So this works out as e power sigma squared minus 1. So you add 1 to it, it becomes e power sigma squared. You take the logarithm of it, it becomes a sigma squared. Logarithm of this is sigma squared. So from here you can find out the sigma, or you can keep the sigma squared itself as this much. So from here we'll get the sigma squared as 0.01032. So we can take this as sigma squared. The same logic now, e power mu plus half sigma squared is equal to 1.08. So basically mu plus half sigma squared will become log 1.08. This is mu plus half sigma squared. So mu will become that number minus half sigma squared. So mu is becoming this number minus half into sigma squared, this number. So this is what is the value of mu. So for this log normal distribution we got, so 1 plus I is following a log normal distribution with mean 0.0718 and variance 0.01032. So which means 1 plus I to the power 10 will follow a log normal distribution of 7.718 10 times and 0.1032. This is what the mean. So 10 mu is nothing but 10 times the mu, and 10 sigma squared is nothing but 10 times the sigma squared here. So these are for 1 plus I to the power 10. So now we are saying the probability of S10 lesser than 1.295, right? So which is also like probability of 1 plus I to the power 10 less than 1.295. So when this is following a log normal distribution, obviously the log of it, probability of log 1 plus I to the power 10 should be less than probability of log 1.295, and this would follow a normal distribution. So log 1.295, right, log of RHS when I take, it becomes log 1.295, so which will say that 0.258. So what is the probability that this log is less than 0.258? And we have said that this follows a log normal, this follows a normal distribution, right? When it was mu, this follows a normal distribution with those kind of mean and standard deviations. So I can very well talk about the probability of Z less than 0.258 minus what is the mean? The 10 mu 0.718 divided by what is the standard deviation, square root of 0.103. What is this particular value? So the Z which I am calculating is coming out as 0.258 minus 0.718 divided by the square root of the standard deviation, this one. So overall saying Z less than minus 1.42. So the probability of Z less than minus 1.42, which probably I can go with the normal distribution or normal standard normal distribution function, where I could take the Z and finally get 7.64%. Looking out in the normal distribution tables, there is a 7.64% chance that the accumulated value will be less than 60% of the expected value. Will be less than the 60% of the expected value. There is around 7.64%. Now, what is the other side that is being asked? How much the company should invest at time t equal to 0, some x, such that the accumulated value at time 10 exceeds the maturity payout. What is the maturity payout here? 20,000 into 1.5, 30,000, right? How much should the accumulate? So the accumulated, the probability of the S10 on some investment X, probability of X into S10 should be greater than 30,000, and this probability should be at least 95%. The probability of whatever the X that is invested with the accumulation factor greater than 30,000, the minimum probability should be 95%, means the value should be greater than that much itself. So it's as good as saying probability of S10 greater than 30,000 by X is 95%. So what is S10 for us? 1 plus I to the power 10. So I could take the logarithm, because logarithm of S10 will follow a normal distribution. So log 30,000 by X. So the probability of log S10 greater than 30,000 by X, log 30,000 by X is at least 95%. So from this, okay, what is so some particular value greater than this much. So what we are going to get is the probability of this number greater than, so the S10 for us, okay, so you can very well talk about probability of what is log S10. We can find out, right, the probability of log S10 greater than 30,000 by X. I have to determine that particular X. Okay, so this is greater than 95%. So what is the corresponding value of this greater than probability of this greater than 95% on a normal distribution curve when we are looking at 30,000 by X? So when we are checking this out on a normal distribution, the S10 should be greater than this. So which means this 30,000 by X should be somewhere here, and 95% of the values, the S10 should be greater than something here, and the 95% of the value should be toward this side, right? 95% of the value should be toward this side. So which means I can find out this particular value is minus 1.65. So all I could say is my Z value is minus 1.65. So I could say 30,000 by X minus mean minus 0.71 divided by standard deviation square root of 0.1032 should be equal to minus 1.65. So based on this we can get, right, so we can find out for corresponding to 5%, I can take the normal distribution or norm inverse corresponding to 5% probability. I can take it as minus 1.6445, that I multiply it with the square root of the variance 10 sigma squared to get this one, and 30,000 by X is the mean plus that. So I'll get the mean is this one plus this gives me 30,000 by X. So X will come out as 30,000 divided by this much. 1.65. Okay, 30,000 by X. Okay, here if I am taking all these in terms of 71 and 0.1032, even I should not take it as 30,000, I have to take it as 1.5. So 1.5 divided by x. So 30,000 by, instead of 30,000 by x, I should write it as 1.5 by x minus this minus this. So when I do it, 1.5 by x is this much. So x is coming out to 7.9. No, I think we have made some mistake somewhere. Z is minus 1.65. Alright, here actually log 30,000 by x. We missed this out. This is not 30,000 by x. So log 30,000 by x. So probably I should look at it like minus 1.6445 is equal to log 30,000 by x minus the mean. So here I should, whatever I am getting, right, this is log 30,000 by x. So this is coming out to not 30,000 by x, this is log 30,000 by x. So if I want 30,000 by x, I'll take it as e power this is 30,000 by x. So from here I am working out my x as 30,000 divided by this much, almost 24,800. So if the company is depositing, instead of the 20,000, if it is going to deposit 24,800, 95% chance that it will not, that its accumulated value will not fall below the target at all. I can say in 95% of the cases, the accumulated value will not fall below the 1.5 times the 20,000. So that is how we are trying to find out what should be the minimum investment that is required so that the accumulated value does not fall below a certain percentage, taking into consideration the variability in the interest rates, the stochastic nature of the interest rates, and taking them into the appropriate mean and variance and the relevant calculations. Alright, so this one numerical can give a lot of clarity in terms of the fluctuating interest rates, what could be the accumulated value, how could the accumulated value vary, and what are the typical ranges and what are the probabilities of falling below a certain amount, crossing a certain amount, and all those kind of scenarios. Right, a bit of more practice into the same will give you more hold in terms of handling this stochastic interest rates kind of scenarios. Alright. So another numerical that is relating to this stochastic interest rates itself and associating the computation of the probability of an interest rate greater than a particular value. So the monthly return I on a fund has a mean of 1.7%. So expected return of I is 1.7 and the standard deviation of 2%. So SD of I is 2%. Now we are saying 1 plus I is log normally distributed. So log 1 plus I actually is normally distributed. Okay. Now I need to find out from this what is the mu and the sigma squared. So because 1 plus I is log normally distributed, the expected value of 1 plus I is nothing but e power mu plus half sigma squared. Right? So here expected value of 1 plus expected value of I. So probably this I could have very well written it as 1.017 is equal to e power mu plus half sigma squared. This is my first equation. Then similarly I have variance of I is, we have the formula of e power 2 mu plus sigma squared into e power sigma squared minus 1. So variance of I is standard deviation. So variance of 1 plus I. Variance of 1 plus I is same as variance of I only because constant does not make any impact in terms of the variance. So standard deviation of I is 2% means variance of I is 2% square is equal to this part e power 2 mu plus sigma squared can be written as e power mu plus half sigma squared whole squared. So this can be written as 1.07 squared into e power sigma squared minus 1. So from here I can get sigma squared, right? This is 2% squared divided by 1.017 squared is nothing but e power sigma squared minus 1. Right? So let me try to simplify this part. Okay. So expected value of I is 1.7%. The standard deviation of I is 2%. So the variance of I will come out to 2% square. Okay. So mu plus half sigma squared. Expected value of 1 plus I. This will come out as 1 plus this number, which probably I can write it in the form of general, making it as 1.017. Variance of I or variance of 1 plus I should be the same as variance of I also, so I'll take this as this. So basically all I require is e power sigma squared minus 1 is nothing but, right, e power sigma squared minus e power sigma squared minus 1 is nothing but the variance of I divided by 1.017 squared. So this is e power sigma squared minus 1. So e power sigma squared will come out as the addition of these two. This is e power sigma squared. Sigma squared will come out as the logarithm of this. So log of this is the value of sigma squared and square root of this will give me the value of sigma. So sigma of 1 plus I is coming out to 1.97%. Right, so we got sigma as 1.97%. Sigma squared is 1.97% squared. Then I can substitute it here. 1.017 equal to e power mu plus half. Sigma squared I know is this much. 0.000387. So I take the logarithm of this, it gives me mu plus half sigma squared, right? So I'll take the logarithm of 1.017, it gives me mu plus half sigma squared. So mu will come out as this number minus half whatever is the sigma squared. Mu plus mu half sigma squared is giving me the main value of mu. So in this case the mu is becoming 1.6%, that is 1.67% is the value of mu. So now we know that 1 plus I is following a log normal distribution with a mean of with a mu of 1.67 and sigma squared as 1.97 squared. These are the parameters. So just writing it a little bit more, log 1 plus I actually is following a normal distribution with the same 1.67% and 1.97% squared. Then log 1 plus I minus 1.67% divided by 1.97% is following a normal distribution with 0 and 1, a standard normal kind of a distribution. So calculate the value of k such that the probability of I being greater than k is 80%. So in case of a normal distribution, I want to find out this particular value of k, right, where this area is more than 80%. So probably the other way of talking about is this greater than some p, that should be 80%, right? So log 1 plus I minus 1.67% divided by 1.97% greater than some particular this one. So probably I'll call this point as P. This particular point, this should be 80%. So this particular point on a standard normal distribution, I can very well get it. So corresponding to this, I will try to find out the normal standard normal distribution. Let's say corresponding to 20% probability is coming out to minus 0.84. So this P, I will call it as minus 0.84. So it's like log 1 plus I minus 1.67% should be greater than 1.97% of minus 0.84. So this I will take a multiplication between this and 1.97%. So this much. And log 1 plus I should be greater than 1.67% plus this. So 1.67% plus this. So log 1 plus I should be greater than this much. So 1 plus I should be greater than e power this much. So 1 plus I is greater than this, which means I is greater than this minus this. So I should be greater than 0.01% or probably 0.0114%. As long as I is greater than 0.0114%, we are talking about the probability of I is greater than k is that k is 0.114%. So that probability in this case of this stochastic variable interest rates is coming out to be around 80%. So this is how we can get into a step-by-step kind of a solving process also to arrive at in this normal distribution, the monthly returns having some kind of a pattern. So what should be that minimum value of I, beyond which what should be that minimum cutoff value where you can see that the chances of I greater than that much is at least 80%. So the chances of I being greater than 0.0% is around 80%. The chances of I going negative below the 0.114% is somewhere around 20%, but the chances of I being greater than 0 is somewhere around 80%. That is how we can interpret this kind of a numerical. Alright. Just as a continuation to the previous example, if my interest rates are following a log normal distribution, especially 1 plus I is following a log normal distribution with a mean equal to 0.0525 and variance equal to this much, we have tried finding out the expected value of 1 plus I by simply finding out the value of e power mu plus half sigma squared, and from there we have computed I, expected value of the I, as 5.61%. But here my intention is not finding out the expected accumulated value as in case of earlier example, but I want to know what is the probability, what is the probability that the accumulation of a single investment of 1. Here I am not even looking out for regular investment also. I am simply looking out for a single investment of 1, not every year. I am making things simpler. A one-time investment of 1 at the end of 24 years is greater than the expected value of the accumulation. What is the chance that the actual accumulation is more than the expected value of the accumulation? So how do I find out the expected value of accumulation? So the mean value is around 5.61. So probably I can very well find out, in this case, the expected value of the accumulation is nothing but 1 plus 5.61% to the power 24. So my accumulated value, my expected value of accumulation is coming out to somewhere around 3.71. Right? Now I want to know what is the probability that the actual accumulation, if 1 plus I, which is a 1 year return, is following a log normal distribution with some mean mu and some sigma squared, as if I want 24 years, so S24, which is nothing but 1 plus I to the power 24, this will follow a log normal distribution with 24 mu and 24 sigma squared, correct? This will follow a log normal distribution with 24 mu and 24 sigma squared. That is the property of log normal distribution. If A follows a log normal distribution with x and y, we are saying A power n follows a log normal distribution with parameters as nx and ny. So the same logic I am applying here. 1 plus I is following a log normal distribution with mean of mu and variance as sigma squared. Then the S24, which is nothing but 1 plus I to the power 24, will follow a log normal distribution of 24 mu and 24 sigma squared. Right? Because so the parameters will be 24 mu and 24 sigma squared, which means on the other side I can very well take the logarithm, saying the logarithm of S24 will follow a normal distribution with parameters 24 mu and 24 sigma squared. So I can find out 24 mu and 24 sigma squared. So I can find out the parameters, which are 24 times the mu, right? The mu in this case is 0.0525 and sigma squared 24. Sigma squared is also 24 times 0.00425. So the parameters wise, these are the parameters for the new log normal distribution, or the log of S24 will follow a normal distribution with this mean and this as the variance. Now my question is, find out what is the probability that S24 is greater than the expected value of S24. Now expected value of S24 we have already found out. The expected accumulation is 3.71. So what is the probability that S24 is greater than 3.71, or what is the probability that log S24 is greater than log 3.71? What is the value of this log 3.71? I can find out log 3.71, which is working out to 1.31. So what is the probability that log S24 is greater than 1.31? So for that, okay, now this log S24 is following a normal distribution. So 1.31 if I am looking at, right, the mean value is 1.26. For this normal distribution, the mean is 1.26. So I want to find out 1.31 and above. What is the probability of 1.31 and above? For that I can take the probability that Z is greater than x minus mu by sigma. So x minus mu, which is the mean for this 1.28, divided by sigma, the standard deviation, the variance is 0.102. So I can take the standard deviation as square root of 0.102. So I am looking at probability of Z greater than, so I am looking at Z greater than, here I am trying to find out 1.31 minus 1.26 divided by square root of the standard deviation, or square root of the variance, which is the standard deviation. So Z greater than 0.15. That is the value I am looking at. The Z value greater than 0.15 or 0.16. So either I can refer to a normal distribution table, or probably here itself I can arrive at using the formula of Excel. I can use norm S distribution. The norm S distribution where I am taking the value of Z, and this is coming out to 0.56 from the left hand side. So from here I can very well take the 1 minus of it, because I want the right hand side of this curve, this area. So I will take 1 minus of it, which is accounting for almost 43.65%. So there is a 43.66% chance. There is a 43.66% chance that the accumulation of a single investment of $1 will be greater than its expected value in 24 years. After 24 years, the probability that the accumulated value is greater than the expected value is around 43.66%. So for that, what is that we have done? First we have found out what is the expected value. The expected value can be understood by finding out the expected value of I. Based on the expected value of I, we have taken for 24 years compounding of that I to find out the expected accumulated value, because we are not talking about an annuity kind of investment here. This is more of a single lump sum kind of an investment. So the accumulated value is nothing but 1 plus I to the power n, which has given me the expected accumulated value. But as we know that 1 plus I is following a log normal distribution, S also will follow a log normal distribution only. So if I want S24, it is nothing but 1 plus I to the power 24, which is again following a log normal distribution with 24 mu and 24 sigma squared as the parameters. So once a particular data is following a log normal distribution, the logarithm of that is following a normal distribution. So once I know that log S24 follows a normal distribution, I am trying to find what is the probability that it will be greater than the mean. Now the mean I know, the variance I know, because the log normal has been converted into normal. So using the mean and the variance, I can find out the z value which exceeds a particular threshold level, and based on that we can say that this is the probability that the actual value will be greater than the expected value. So this is the benefit that we derive using the stochastic interest rate. We can even say with this kind of variance that is present, this is the chance that the price will be greater than this much. This is the chance that the returns will be greater than this much. This is the chance that the final accumulated value will be greater than the expected. All these kind of probabilistic related statements can be brought out through the usage of stochastic interest rates. Alright. Okay, now let's look out for computing the expected profit in any investment, especially where the amount that needs to be invested is purely based on the probabilistic movements of the interest rates over a period, right? And how does the expected profit arise in that kind of a scenario? Just look at this. A fund has a liability to pay 20,000 at the end of 5 years. So 0th year, the 5th year. Now I have to pay 20,000 at this point in time. To meet its liability, the fund manager invests in a 5-year zero coupon bond. Something is invested which provides any one of the annual returns. So either 5% return is provided, or 7% return is provided, or a 9% return is provided, with 20% probability, 45% probability, and 35% probability over the next 5 years. So basically it's like he is going to generate either a 5% return with a 20% chance, a 7% return with a 45% chance, and a 9% return with a 0.35 35% chance. So the fund manager invests the present value of the liability at the expected rate of interest. So what is the expected interest rate in this case? Expected rate of interest in this case is nothing but this multiplied by this, a simple probabilistic scenario, weighted average of the various returns. So giving me that the expected rate in this case is working out to 7.3%. So the investment is done at the expected rate of interest. So based on this, if I want to find out what is the actual invested amount, which is nothing but the present value of my 20,000 discounted at this 7.3% over a 5-year period. So I'll take it as 20,000 divided by 1 plus this expected rate of return to the power 5. So coming out that this person has to invest 14,061 rupees 49 paisa. This should be the invested amount. And now what I am saying is, okay, let's assume that he has invested 14,061 rupees 49 paisa here. Now what we are saying is this could give either a 5% return with a 20% chance. This could give 7% return with a 45% chance and 9% return with a 35% chance, right? So probably what we are seeing is if it is giving a 5% return, what are the possible profits, accumulated values? Okay, accumulated values. Let's say if it is giving 5% return, it becomes this multiplied by 1 plus 5% to the power 5. So it is going to give me this much. If it is giving me 7% return, it is going to work out to this into 1 plus 7% to the power 5. So it can give me this much. Or if it is going to give me a 9% return, it's going to be 1 plus 9% to the power 5. So I'll get 17,900 with a probability of 20%. I'll get 19,720 with a probability of 45%, and I'm going to get 21,600 with a probability of 35%. So I can find out the expected accumulated value based on this, which will give me 20% into this accumulated value, 45%. So I can find here instead of here, I'll say expected accumulated value. So I'll get 20% multiplied by this, 45% multiplied by 19,000, 35% multiplied by 21,000. So it is giving me an expected value of 20,036. So from here I can find out my expected profit, which is nothing but whatever is the expected accumulated value minus what is the liability that needs to be paid off, giving me 36.54 rupees is the expected profit, especially if the investment is being made based on the expected rate of interest for each of the period. So we have to understand the difference between what we are talking about as an expected rate of interest here and how we are trying to find out the expected profit when the investment is being made at this particular rate of interest. Alright.